Have you ever wondered how your money could work for you? Now, this isn't some kind of magic trick or get-rich-quick scheme. No, it's a simple yet powerful concept known as compound interest. Imagine a snowball rolling down a hill. As it rolls, it picks up more snow, growing larger and larger. That's essentially how compound interest works. The money you invest earns interest, and then that interest earns interest on itself, and so on. It's a cycle that, over time, can turn small amounts of money into substantial sums. But here's the catch. For compound interest to work its magic, it needs two things: time and consistency. Time is straightforward. The longer your money is invested, the more time it has to grow. That's why starting early is so crucial. Consider this: if you start investing just $100 a month at the age of 25, with an average annual return of 7%, by the time you turn 65, you'd have over $340,000. But if you wait until you're 35 to start investing that same $100 a month, you'd end up with less than half, around $150,000. That's the power of starting early. Consistency, on the other hand, is about making regular investments regardless of how small they may be. Consistent investing allows your money to keep growing, feeding the cycle of compound interest. It's like watering a plant. A little bit every day can help it thrive. To make consistency easier, consider setting up automatic contributions to your investment accounts. This way, you're regularly investing without even thinking about it, letting compound interest do its work. So, whether you're just starting your investment journey or you're looking to maximize your returns, remember the power of compound interest. It's not about making a quick buck, it's about creating lasting wealth. It's about letting your money work for you. And remember, the sooner you start, the greater the power of compound interest. The early bird not only gets the worm, but also the bigger nest egg. Now let's dive into the crux of the matter. When it comes to investing, time is your most powerful ally. The sooner you start, the more time you have for your investments to grow and compound. Imagine you're only 20 years old and you decide to invest $100 every month. By the time you reach 60, assuming an average annual return of 7%, you would have accumulated over $300,000. Now, if you waited until you were 30 to start investing the same amount, you'd have just over $150,000 by the time you hit 60. That's half the amount. This is the magic of starting early and harnessing the power of compound interest. So don't delay. Start your investment journey today. Investing isn't a one-time affair. It's a habit. And like a good habit, it requires consistency. The power of compound interest doesn't lie in the amount you invest, but in the regularity of your investments. Think of it like a workout routine, where consistency is key to seeing results over time. Now, how do you ensure this consistency? One practical way is by setting up automatic contributions to your investment accounts. This can be as simple as a standing instruction to your bank to transfer a certain amount of money to your investment account each month. It's like setting up a direct debit for your bills, only this time, you're paying your future self. This approach takes the guesswork and emotional decision-making out of the equation, making it more likely that you will stick to your investing routine. Remember, it's not about how much you invest, but how regularly you do it. Consistency, not the amount, makes the magic happen over time. Are you leaving free money on the table? Now you might be wondering, what free money? Well, we're talking about employer-sponsored retirement plans. These plans, such as the 401k or 403b, are a fantastic way to boost your retirement savings. Here's the deal. Many employers offer a match to your contributions. That means for every dollar you put in, your employer may also put in $1 up to a certain percentage. This is essentially free money that's added to your retirement pot. Additionally, the money you contribute is often pre-tax, reducing your taxable income for the year. Over time, this can lead to significant tax savings. But how can you maximize these benefits? The answer is simple. Contribute as much as you can, especially enough to get the full employer match. Be sure to diversify your investments within the plan and review regularly to ensure your selection aligns with your financial goals. Take full advantage of these plans. They are a golden ticket to your retirement dreams. Don't put all your eggs in one basket. This timeless adage perfectly encapsulates the concept of diversification in investing. Diversification, in essence, is the practice of spreading your investments across various asset classes such as stocks, bonds, and real estate to mitigate risk. If one asset class performs poorly, others may perform well, and this balance can help to protect your portfolio from significant losses. Now, how do you go about building a diversified portfolio? Start by identifying your investment goals and risk tolerance. Then consider investing in a mix of asset classes. This could include a blend of domestic and international stocks, government and corporate bonds, and perhaps even some commodities or real estate. Consider using mutual funds or exchange-traded funds, which provide instant diversification by pooling your money with other investors to buy a broad range of assets. Remember, diversification isn't about chasing the highest returns, it's about managing risk. Remember, a well-diversified portfolio can weather any storm. Beware of the silent wealth killer, fees. Investment fees, though they may seem small and insignificant, can eat away at your returns over time. It's like a slow leak in your wealth-building bucket. Think about it this way, even a 1% fee can reduce your gains by nearly a third over a 20-year period. That's a chunk of change you'd probably rather keep in your pocket, right? So what can we do to combat this silent wealth killer? The answer lies in choosing low-cost investment options. Index funds and exchange-traded funds, or ETFs, are prime examples. These funds simply aim to match the performance of a specific market index, rather than trying to beat the market. This passive management approach keeps costs low, allowing you to keep more of your returns. Remember, every dollar you save on fees is another dollar working for you, compounding and growing your wealth. Keep more of your hard-earned money by minimizing fees. What should you do with your dividends? Now that's a question worth pondering. When you receive dividends, it's tempting to see them as a bonus, a little extra cash in your pocket. But that's not the most powerful way to use them. Instead, consider reinvesting those dividends back into your investment. Why? Because reinvesting dividends is like adding fuel to the fire of compound interest. Every time you reinvest a dividend, you increase the size of your investment without adding any additional money out of pocket. This means you own more shares, and those additional shares can generate even more dividends. It's a cycle that can accelerate the growth of your investments over time. Setting up a dividend reinvestment plan, also known as a DRIP, can make this process automatic. Many brokerage accounts also offer the option to automatically reinvest dividends. So, look into these options and let your dividends work for you. Reinvesting dividends can turn a small snowball into a giant snowman. Investing is a marathon, not a sprint. Remember, it's essential to keep pace with the ever-evolving world of finance. Continually educate yourself about investment strategies and market trends. Read financial literature, attend webinars, participate in forums, and engage with like-minded individuals. This active pursuit of knowledge will help you make informed decisions and adapt your strategies as needed. Yet, with all the information at your fingertips, it's easy to get swayed by the daily ebb and flow of the financial markets. It's crucial to maintain a long-term perspective. Markets will inevitably fluctuate, but don't let these short-term variations trigger emotional reactions. Stick to your financial plan, and remember, it's the overall trend that matters, not the daily ups and downs. In this journey, patience is your best ally. It's the steady, consistent contributions over time that harness the power of compound interest and lead to significant wealth accumulation. Stay informed, stay the course, and watch your wealth grow. Let's recap the journey we've taken today. We have unlocked the magic of compound interest, the silent force that amplifies your wealth over time. We've understood the power of starting early, making even the smallest contributions count. We've underscored the importance of consistency, a habit that turns pennies into fortunes. We've delved into employer-sponsored retirement plans and how they offer an easy route to steady wealth accumulation. We've navigated the landscape of diversification, the strategy that keeps your investments safe and balanced. We've highlighted the need to minimize fees to keep more of your returns in your pocket. We've explored the benefits of reinvesting dividends, a clever way to boost your investments. And finally, we've encouraged staying informed and committed, because the road to wealth is a marathon, not a sprint. Compound interest is transformative. It's how small steps today can lead to giant leaps tomorrow. Take action today. Your future self will thank you, and don't forget to subscribe for more smart money tips.